In this video, I am going to walk you through 10 multiple choice questions from the IMA support package for CMA candidates. If you want to have access to this package, please click the video description below and click on the link. You will also be given access to a cheat sheet I've created with formulas and all concepts you need to know to pass the CMA exams. But in this video, I will solve 10 questions, question number 51 to 60. And I have a series of videos I've made, and check my previous videos and also check my next videos as I take you through this and explain things as details as I can. Question number 51. Sorry. Okay, so let's go. The dollar value of a company's ending inventory on its balance sheet was 500,000. So 500, 600, and 400 for year 1, 2, 3, respectively. In preparing horizontal analysis with year 1 as the base, the percentage change shown for year 3 is. All right. So we need to find the percentage change for year 3. All right. There are two methods you can solve this. Okay. So let's start with method number 1. So let's see. Method 1. We are going to take the 400,000, and by the way, I will do it in thousands, so I will get rid of the extra zeros, so my calculations will be faster and easier. So method 1, we have 400 the current, so 400 divided by 500. Or we could have even do 4 divided by 5 and minus 1. Okay, so that gives us 0.8 minus 1, which is equal to 0.2, which is a negative. So we know answer choice will be B according to this method, which is negative 20%. Or we can do method 2. So the second method, we are going to have 500 minus 400 divided by 500, which will give us a 500 minus 400, but it is a decrease. So 400 minus 500. So let's redo this because that is a decrease. So we have 400 minus 500, which is negative 100 divided by 500. So that gives 0.2, which is a negative. The reason it's negative is we had 500 and now it's decreased to 400. Okay, and we are doing only 30 years, so we only need 30-year numbers and compare it with the first year number. So the correct answer for question number 51 is B, 20%. Question number 52, a company has 100,000 of sales, 600,000 of variable costs, so we have 100, 600, and 300,000 of fixed expense. The degree of operation leverage is, okay, so you need to know a formula for degree of operation. This is why you need my cheat sheet. Okay, this is the reason I am recommending you having access to my in that cheat sheet. You have access to all the formulas. Formulas I've created and in one place, and also some concepts you need to know and some techniques. So let's go ahead and solve question number 52, which has this operation leverage. What is degree of operation leverage? It's a contribution margin divided by EBIT. Or if there's a changes in it, we're going to have changes in EBIT divided by change in sales, which it doesn't seem that's what we're going to do. So we're going to go ahead and do contribution margin. Contribution margin is sales minus variable cost. So we have 100 minus 60. I just did it in 1,000, get rid of the zeros. 100 minus 60 divided by operating profit earning before tax is 100 minus 60 minus 30, because we need to subtract the fixed cost to get to earning before income and tax. So we're going to have here 40 divided by 10, which will give us 4 divided by 1 is 4. So the correct answer here is 4, which is D. So the correct answer for question number 52 is D, which is 4. Question number 53. So During a presentation on non-discounted cash flows, we have non-discounted cash flow method for capital budgeting decision, and analyst made the following two statements concerning the payback period. All right. So we know payback period does not take into consideration time value of money. Okay, so we know that. And so the statement made here is it is the best decision criteria for accepting, rejecting, and so. But let's talk about payback period for a second. So we have payback. There's difference between discounted payback and payback period. For just payback period, it doesn't take into it disregard time value of money, but it shows liquidity. So it shows liquidity, and it shows the risk because more liquid it is, less risky it is. So it shows risk, and it also disregard one thing. It disregard cash flow after payback period. Okay, so once we get our payback, whatever cash flow after that is irrelevant. It disregard that. So let's see if the statement, which statement is correct. So we're going to find the analyze correct regarding, okay. 53, so statement number 1, it says it is the best decision criteria for accepting and rejecting. Well, statement number 1 is not the best, okay. If you want to know, the best one is ones with time value of money consideration, which is net present value, and also IRR in some cases. So we know option A is not the correct answer because statement 1 is not correct. And it's also said both statement 1 and 2, so we can eliminate D. So now we have B and C, either 2 alone or either neither 1 or 2. So either 2 is correct or none is correct statement. And statement 2 said it may encourage excessive investment in short term. All right, so that's a key word here. In a short-term project at the expense of investment in long-term project. Okay. Because it is disregard cash flow after payback, it may encourage short-term projects, okay, of investment in long-term project. Once we get our payback quickly, we think that's the most profitable one. So statement 2 is the correct. So statement 2 alone is correct. So we're going to select that. So question number 53 is B. Question number 54. So we have here a U.S. company has account receivable from a Swiss company for 100,000 francs due in 3 months. At the time of contract, the exchange rate was 1.06. Okay, so that's 1-to-1, and the U.S. company wishes to manage its foreign exchange exposure, and therefore, what should it do? Okay, pause this question, solve it, and let's compare answers. I recommend that you do that with every question that I solve here. So, while we have account receivable, once I see the account receivable, it tells me something. It tells me that the company is a seller. Okay, what does a seller do in this case? Seller gains. So a seller will gain if the CHF goes up. Okay, but loses if CHF depreciate. So the best thing to do is to sell CHF. Okay, to hedge it. So that's where we hedge it. So Emily can hedge this by selling CHF. So let's go to the multiple choice question and see. So we see that buys current swap within a creditor says Swiss francs futures, and I think that's the that's the CHF. So that is the correct answer from my explanation here. So we would choose that and move on since we are confident we have explained things and we know B is the correct answer. Question number 55. All right. A company has a portfolio of 4 products and incurs 175,000 of allocated fixed cost per year. Financial data for the 4 products is shown below. When you get this question again, go ahead and read the question. Okay. So which of the products should a company discontinue? All right. So which one should we discontinue? That's what's being asked here. To make a better decision for this, we need to find contribution margin. Okay, the contribution margin will be the most appropriate to make decision. We're going to disregard the fixed cost. So because the fixed cost is allocation, okay, allocation fixed cost. We don't. We're going to incur it no matter what. Whether we get rid of D, B, C, or A, we're still going to incur the fixed cost. So it's irrelevant, which is committed cost. If it's committed or unavoidable, it's irrelevant. Okay. So I'm going to make a little table here. So we have sales and we have variable cost and we have contribution margin. So we know, let's start with A. A has 750,000 sales. All right, so what is our contribution margin then? Contribution margin is 25,000. No, variable cost is 25,000 multiplied by 24. So 25,000 multiplied by 24. 24 multiplied by 25,000. So that is our variable cost. So now our contribution margin will give us 150,000. We go to B. B has 600,000 sales. And our variable cost will be 24 multiplied by 18,750. 18,750. Okay, so we are going to subtract this subtraction, sales minus a variable cost, and that will give us also 150,000. We go to company C, so I'm going to write C here. C has 150,000. And we're going to have a variable cost of 37 multiplied by 3750. So 37 multiplied by 3750. So that is a subtraction. And we are going to have 11,250. Company D has 100,000 total sales. And we are going to have 41 multiplied by 2,500. So 2,500 multiplied by 41, which is 41 here, and that will give us 2,500 negative. So we know that according to the information we have here, we should eliminate product D because it gives us incremental loss. Okay, we have incremental loss, so we should eliminate product D. So we should discontinue product D, which is answer choice D. So the correct answer is D, eliminate product D. Question number 56. All right, so you have 56 here. A company has a current ratio of 2, cash ratio, cash is 20%, account receivable is 40%, and inventory is 40%, a total of current asset. What is the asset test ratio for this company? All right, so what's the definition or what is the formula for asset test ratio? Asset test ratio, all right, ATR, I'm going to do ATR, is current asset minus inventory divided by current liability. All right, so that's it. Okay, so now what is our current asset minus inventory? So current asset we know is 1. So 1 is the whole percentage, 100%. So let's assume it's a 1 minus inventory is 40%, which is 0.4. Okay, or divided by current liability. And current liability is what we do not know. Okay, we don't know right now what current liability is. So we're going to calculate current liability by using current ratio. Okay, and current ratio is current asset divided by current liability. Okay, We know current ratio, we have been given current ratio of 2. So we have 2 equal to current asset of 1 divided by X. Okay. 1 divided by X. So we do more cross multiplication. So we have 2X equal to 1. So divided by 2 will give us 0.5. So we are going to use 0.5 here. So we're going to use this answer here. So current liability is 0.5. So we are going to have 0.6 divided by 0.5, and the answer is 1.2. So the correct answer for asset test ratio is 1.2, which is B. So we're going to highlight B, correct answer 1.2. So let's move on to question number 57. This also has a lot of information and data. I'm not going to read everything. Do not do that. That will also help you. Okay, go straight to the question or what is required, usually at the bottom of the paragraph. We are going to do, since the amateur line shows a loss, okay, so amateur line shows a loss, the company is possibly eliminating this line of tennis shoes. Based on the data provided, should the company drop the amateur tennis shoe? Okay, so should we drop it or continue? Okay, based on what we see here. All right. I recommend that when you're doing this thing, so you know right now that should I drop amateur or continue? Okay, so the decision is based on amateur, and because amateur has a net profit of 62, operating income of 62,500. Is it the reason? Okay, is this why the company is losing? I recommend that you start with operating income. So if we get rid of amateur, we are going to save 62,500. That is the savings. Because we think we are losing, so we are going to save 62,500. All right. Although we're saving 62,500, this cost, okay, this is allocated cost, is unavoidable. It's still going to be there. So we can't avoid allocated fixed cost. So we are going to lose 102,500. Okay, so that is our loss because it's still going to be there. So we add them up together and we are losing 50,000 if we get rid of amateur, because amateur has a contribution margin that is paying for some of this huge allocated cost. Okay, amateur is paying for this huge allocated cost. So if we get rid of it, we will need 50,000 more to pay for the allocated cost. So that is why we will be losing 50,000. So drop it. We will say no, but how much will it decrease? It will decrease by 50,000. So that is why the correct answer here for question number 57 is A. And we're going to highlight that as the right answer. Question number 58. A company is analyzing the opportunity to expand into new market. Okay, the expansion will require an initial investment of 261,600. Cash flow for the new market expansion are forecasted to be 120,000 for the next 3 years. The company has a cost of capital of 8%. The discounted payback period for the new market expansion will be okay. So here we are dealing with discounted payback and not just a payback. So a payback that is discounted. Okay. So the formula for discounted payback is, so discounted payback is initial investment divided by discounted cash inflow. Okay, so initial investment is we are going to invest initially 261,600 divided by discounted cash flow. how do we get a discounted cash flow? I see if we have, okay, we have 120,000. That is the same payment. And we're going to multiply that by 3 years at 8%. Okay. So in my previous video, I show you how to find this. Okay, when we have the same payment, if we have the same payment, we are going to multiply that by PV of annuity, which is the same payment, okay, for 3 years. But if we have a single payment, then we're going to use the PV. So in here, we are going to use the PV of annuity to find 120,000, discounted 120,000. So let's go to the table. So we have a table here, PV table, and PV of annuity. Let's see, so 3 years at 8%. So we are going to have 8% here, and we are going to have 3 years here. All right, so that'll be 2.577. 2.577. So when we calculate that, 120,000 multiplied by 2.577 is 309. So we multiply that. So what will be is 120,000 multiplied by 2.577, and that gives us 309,240. Okay. So divide that, we get 0.8459. Okay. So this means of the entire 3 years project, it's going to take us 84% of the time to recover the whole amount. Okay. And the whole amount of the investment of the whole entire project. So we are going to multiply the 80% or 84.5% by the 3 years. So as we multiply by it, we get 2.538. Okay, and then the closest one to 2.538 is 2.5 years, which is C. So the correct answer here is C, 2.5 years, because it's going to take us 80% of the whole 3 years to recover the initial investment. So 80% of the whole 3 years to recover the initial investment. That's why we multiply it by that and to get 2.5 years. Good. So let's move on to the next question, which is question number 59. Question number 59. A company has earnings before interest and taxes of 100,000, income taxes of 30,000, and interest expense of 10,000. The company's interest coverage ratio. All right, so interest coverage ratio. What is the formula for interest coverage ratio? The formula is, what's it, EBIT, so EBIT, any before interest and taxes divided by interest expense. What is interest before taxes? Income before interest and taxes is 100,000. So I'm just going to do 100 divided by interest expense is 10. So equal to 10. So the correct answer is 10, and then we have 10 here. So the correct answer according to the option is D. So we're going to choose D. This is the last question in this video series. Watch my next video as I continue with solving the questions. A company, so this is also has a data. I'm not going to read it. I'm going to go straight forward and read what is here, what is required. Whenever you see a data, don't worry yourself about reading everything. So the company's operating profit margin percentages. Okay, so what is operating profit margin? It is operating profit divided by sales. Now, what is our operating profit? Operating profits will be sales 2,000 minus cost of goods sold 800 minus 400 operating expenses. Do not include interest expense and tax. Okay, so those are not operating income. Those are income after operating or non-operating income. Okay. So the operating income, because interest expense is not operational. Okay, it's not an operating. It's not a. It's not what generates the normal revenue for the company. So it's not interest expense. I mean, it's just not part of operating income. So once you include this, you will have income. So here we have income before interest and tax. Operating profit is income before. Let me get rid of this. Operating profit, we will consider income before interest and tax. Here we have income before tax. Okay, and after tax, we have net income. So income before interest and tax is the operational. So that is why we don't include the 200 and 300. If you include the 200, consider 200 and 300, I believe you will get an answer, but that will be wrong. So operating profit, we have 2,000 minus 800 minus 400, or divided by sales, which is 2,000. So we are going to have 800 divided by 2,000. And the correct answer right here will be 0.4 or 40%. The correct answer is C, which is 40%. Okay. Great. All right. Well, I recommend that you have access to this IMA support package. Okay. It has good stuff in it. It has things that will prepare you strategically. So check the video description below, click on the link, and you have access to it, including the cheat sheet that I've created. Preparing for the CMA exams, I wish you good luck.